This is Taking Stock on Bloomberg. I'm Pim Fox. So how can industrial companies expand their margins when demand is weak? Well, let's find out. Let's ask an expert. Nick Heymann, analyst and expert in the industrial industry. He follows it for Sterne, Agee, and Leech. Nick, welcome. Always good to have you. So tell me, how do the laws of economics work in an environment when we know growth is slow at best? Yep. And you're saying, hey, but pay attention. There's some industrial companies that might be able to actually expand margins. How do they do that?
Well, near term, certainly aggregate demand is not there, in 09 and 010. And we think you got to focus on flex force, taking your workforce and being able to have part-time employment for people, not laying them all off, so you'd be prepared to come back. Secondly, you've got traditional restructuring, right-sizing your footprint. The third is insourcing, where you're actually now having basically outsourced to meet this peak, unusual period in 07, 08. You're going to bring it in-house and maybe bring it in-house at lower cost than you're actually paying to outsource it. And the fourth thing would be the ability to basically detach your portfolio. Look at, the portfolio, how they performed the last 10 years. If you're only basically covering your cost of capital in 3, you might only get 1 or 2 in the next because you won't have 07 or 08. So maybe it's time to donate those businesses to charity, get a little cash out, and certainly improve your margins in the process. And suddenly, that's the way near term for most industrial manufacturers we're going to see, quote, any surprise.
Step back for me a little bit, because I know you're always got to deal with macro themes, because so many of the companies that you cover, they operate globally. Inflation, deflation, we spend a lot of time debating that. What's your thought?
Thought is that basically we had an all-out effort by governments around the world to avoid deflation. That is resulting in exceptional deficits. And as a result, everybody, including the bond market, has discounted the fact that we're going to have higher interest rates and higher inflation. And the most fungible place for that to show up near term is commodities. So anything related to commodities is moving like the speed of sound. And that in turn has seen our mining stocks move up. Ag stocks have certainly benefited. It's even starting to filter over to the E&C. The other side, the quote-unquote industrial infrastructure, whether the component folks or whether the end products or, commercial aerospace, that's going to take a lot longer, be driven by actually seeing the money enter in orders and then eventually in sales for our companies, and that's probably not an event till 11, 012.
So what about companies right now? Where should investors be looking to deploy some new capital if they want to take advantage of, as you described, this theme of perhaps expanding margins and perhaps factoring in some inflation?
Well, right now there's certainly one company that stands out for us that's doing this very well is United Technologies. And they've got a four-plan part to really do this, restructuring the traditional way, taking out 7% of their workforce. Secondly, they're bringing 18% of what they previously outsourced, 06, 08, back in-house, and they're bringing it into Eastern European plants, which are actually 25% below the cost of what they've actually paid to outsource it. So you're going to get a nice big kick on margins from that. They're also taking and looking at their portfolio very hard to see if businesses that have only moderately been able to earn their cost of capital in a few years in the last decade, maybe they don't belong in the portfolio, because we've had 07 and 08 years are not really the peak years. Peak years, really, when you look back, are probably more like 05 and 06. 07, 08 being, extraordinary years driven by unusual events, negative interest rates, extremely high asset valuations. So we think that, taking and liquidating, donating, whatever you want to call it, businesses that...
Any ideas in your mind? For what areas United Technologies should be looking for?
With their commercial businesses, they've recently announced moves to get out of commercial refrigeration in North America. They've recently announced moves to exit their distribution in the southwestern states for their HVAC. And I think maybe they got a small business that makes hand dryers. You're probably looking at 10% of Carrier's sales that won't be there. They're actually maybe losing money this year. So you could add 100, 125 basis points to Carrier's profit margins and get some cash back in the process. Not such a bad opportunity.
So an efficient use of that cash as well.
Yeah, and they'll put it to use, I think, in terms of both, investing for new products in the markets that they're really, strongly focused on and dominant. They're bringing out new engines at Pratt & Whitney. They're bringing out many new products within the building solutions market and position themselves for what eventually, not near term, but eventually could be a big refurbishment opportunity in helping to reduce and improve energy usage and improve energy efficiency within commercial buildings.
Let me just borrow a word from your last statement. This had to do with aerospace and aircraft, because I want to shift your attention now to Bombardier.
Yes.
We know about its business in the aircraft space. But they're a lot more than aircraft.
That's right. You know, we see three markets, really, in the next 3 to 5 years, Pim, that are going to be able to grow irrespective of all the other elements that aren't there in the industrial space. One would be rail, two would be wind, and then the third would be transmission distribution. Rail, ironically, number one in the world is Bombardier. It's the largest part of their business. Most people think of it as an aerospace company, and they're currently certainly in the midst of a serious downturn in the commercial space for aerospace, but they're moving through it quite adeptly. The business jet market has really probably been pulled forward to a trough this year. Their regional business is doing well. Overall regional aircraft production for them will be up 10% this year. They have the hottest.
It'll be up 10%, even with the downturn.
They've got the hottest, most efficient turboprop, the Q400. Its production will be up 40% there this year. And then they're working on the large commercial introduction for the C Series. And that'll be the first composite single-aisle narrow body out in 13 to be, of course, followed by Boeing and Airbus towards the middle of the decade. But they're really, great backlogs, 2.5 years, excellent cash position, net cash instead of net debt of almost $2 billion here at the beginning of the decade, and a very well-run company. So one that I think is probably exceptional risk-reward right now.
All right, we're going to continue the conversation more with Nick Heymann. He's going to tell us where to put some new money. If you want to take advantage of spending on construction, transportation, and aerospace, the names might surprise you. This is Taking Stock on Bloomberg. And a programming note, Bloomberg's Taking Stock begins each weekday at 3 p.m. Eastern on 1130 Bloomberg AM, as well as on Bloomberg.com. We'll see you then. This is Taking Stock on Bloomberg. I'm Pim Fox. Earnings under pressure, visibility weak, global demand uncertain. So why buy industrial stocks? We're continuing our conversation with Nick Heymann of Sterne, Agee, Leech. I don't want to paint too gloomy a picture, but in fact, Nick, I just want you to give an insight into something that's coming up, which is the big air show. Right. We were just talking about this off camera. What do you expect to hear as a result of the air show getting all the market participants together?
Well, right now, production schedules call for about 940 aircraft between Boeing and Airbus for 010. And I think we're going to see not only 010 adjusted, but perhaps, adjustments. Adjusted down. But we'll also probably see even comments about production possibly being adjusted here in the second half of this year. And the reason is airlines really are looking at taking another 10 or 12% of their fleets out of their current capacity to be able to match, tougher conditions in the global market. Plus, you've got higher oil, which is, 38-40% of airlines' profits and costs. And so you've really got a situation now that could even be further compounded if we got liquidity issues with regards to leasing companies, which are 40% of where the aircraft go. Right.
So there's no one to finance the purchase of new aircraft. So you've got this huge downdraft there. Then you've got the production cuts that you say we might see as a result of all the industry participants coming together and saying, hey, look, I don't want to buy an aircraft now. I don't have the money.
Needing to adjust and adjust sooner, more sharply. And, if in fact, for instance, ILFC cannot be, spun out from AIG, there you've got 49 aircraft, $3.6 billion worth to be delivered this year. Boeing and Airbus have gone back and gotten funds to be able to carry these aircraft. If they can't deliver them to ILFC, they might have to put them in the leasing market at obviously pressuring rates there.
A business that relies on internal financing, probably not a great time to make that happen. But as a result, there are some perhaps winners in this, right? Because if you pull capacity out of the system, which is happening, production goes down, leasing money is not available. What about all those component makers? They got to keep the planes that are up there. They got to keep them flying.
Got to keep them flying, and we are starting to see global flight hours down 8.8% so far this year. The hope is it'll be down 4 or 5. That's probably going to be a little optimistic. My guess is it's probably upper single-digit decline. So there'll be maintenance opportunities, particularly if you have a demographic fleet like GE's. It's relatively young, but it's going to the aftermarket and service side is going to be impacted as well.
All right. Well, let's talk about some of the companies there specifically. Let's start by talking about Eaton Corp. I know you got a neutral rating there. What would shift your rating from neutral? What are you looking at in terms of the downside right now for Eaton? What are they facing?
Eaton, is a very good company, solid leadership position in its markets, but they really are in the kind of middle part of the second half of the industrial recovery. And the first half is more commodity related, and they make good end products, but those products, capital spending is being disrupted right now because of the pace of change in different industry regulatory environments, legislation down in Washington. And so you're getting deferrals. You probably won't see orders for many of Eaton's products really come through from a government stimulus-related standpoint until 2010, which means 2011 type production. So they're working to hunker down, manage through this. And I think they'll come out still in the saddle and in good shape, but it's nothing imminent in terms of any kind of pickup there.
All right, something a little bit perhaps more imminent is Emerson Electric, right? A buy rating there. What's the deal? They're looking to, right-size all of their businesses? What are business conditions like for their operations?
Tough. I mean, orders down 20-25% for the last 3, 4, 5 months. And, the company's taken a much more aggressive right-sizing action with regards to their manufacturing around the world. And I think that, this will start to certainly show by their September quarter. As we look out to next year, a lot of pessimism in the shares. They make components, so as demand begins to pick up, they'll certainly see it earlier. The channels are very dry. And so I think that overall, they'll be in pretty good shape. The big factor for industrials that they're really cautious about, commodity prices rising before that aggregate demand picks up. If you have inflation for your commodities, you don't want to get caught with a big squeeze on your margins.
When you talk about margins, I mean, how does someone like an Emerson actually manage their margins in this environment? I mean, is there any way to hedge their margin position?
Well, it's very unusual. The company has taken and not just talked about not seeing a recovery. They've said, okay, let's take 15-20% of our capacity and mothball it. So the way they get through is they don't get tempted to reduce price to fill their plants, and they hold their price. They get better utilization rates for the plants that they're running, and they have nominal fixed cost for those that they've, quote, mothballed, and the net result is better cash flow and better return on capital through a tough part of the cycle. And then when it comes back, they can turn the lights back on.
Talk, if you can, a little bit using your inflation perspective, because, we've seen oil right now, $71 a barrel. I was talking earlier to Stephen Shork of the Shork Group, talking about energy prices. He says, what could happen is we get ahead of ourselves. The price of all these commodities, particularly energy, rises so much that we choke off any real potential rebound in the economy.
Well, that's definitely true, and you probably back it all the way up to who's borrowing all the money to get the economies going again. And obviously the government's 13% deficit of our GDP this year is twice what we've had, at any time since World War II. And there is concern that you could choke off, private borrowing as the governments around the world really step up and step on the gas to be able to deficit finance. But I think commodities are probably oversold earlier this year on fears the world was going to end. We're probably back in a normalized range. And then when orders start to come for this infrastructure out of governments next year, commodities may resume their upward trend, knowing that that's going to incur and require a lot more, end market, commodity inputs. So we'll see how it goes, but certainly that the squeeze near term in the next 3-4 quarters is what companies are really trying to manage for before that aggregate demand comes back, because if you've got higher input costs, very hard to raise price.
Right. You're not going to be able to pass that along.
No.
All right, I want to thank you very much, Nick Heymann, coming in from Sterne, Agee, Leech, giving us your insight into the world of industrial stocks and a little bit of education about the global macro picture. Thanks very much. Appreciate it.